Hi everybody, Griffin Bridgers here. Today we're going to talk about an older private letter ruling, but in terms of scope, it really illustrated an issue that can pop up when you implement a series of rolling GRATs dealing with the automatic allocation of GST exemption. It's a subject I've talked about before, but this private letter ruling really illustrates the scope of how this problem can spiral out of control if you don't have the right guidance. As always, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, when it comes to GRATs, I've talked about this before. I have an extensive series on the basics of GST tax, and there's a couple other videos that predate that series which touch on this issue as well. But when you have a transfer to a GRAT, it creates what's known as an estate tax inclusion period, or an ETIP. And the significance of that is that you can't automatically or even manually allocate GST exemption to the GRAT until the end of the ETIP. And when does the ETIP end? It ends at the end of the GRAT term. And the issue pops up in terms of the difference in value, the delta between the gift tax determination of value of the GRAT when it's funded and the value at the end of the term. So what do I mean here? Well, the intent of a GRAT is to use present value discounting to achieve a lower gift tax value when compared to the value of the GRAT at the end of the GRAT term. So typically, when you allocate GST exemption, it's based on the gift tax value for a lifetime transfer like this. But because of this ETIP, we can't allocate GST exemption to that lower discounted gift tax value. So the significance is that even though we get that present value discount for gift tax purposes at the time of GRAT funding, we don't get that present value discount for purposes of allocating GST exemption. Instead, we're stuck with a rule that says we can only allocate GST exemption based on the remainder value of the GRAT at the end of the GRAT term, at which point it passes on to other beneficiaries due to that termination of the grantor's interest, which consequentially is what creates the ETIP and creates the termination of the ETIP that creates this issue to begin with. So, a lot of times we need to look at this from the perspective of we don't have a crystal ball. The only time this becomes an issue is when we have a winning GRAT. So what is a winning GRAT? Well, it's a GRAT whose internal rate of return exceeds the 75/20 rate upon which the discount was based at the time of GRAT funding. So in other words, a better way to think of it is if the GRAT leaves a remainder, it is a winning GRAT. If it doesn't, it's a losing GRAT. But in either way, you end up potentially with an issue because if you allocate GST exemption to a losing GRAT, that GST exemption could potentially be wasted, but luckily the ETIP rules prevent us from being able to do so. But at the same time, if the GRAT is going to be a winning GRAT, we hope for that, but we have no idea what that remainder value is going to be at the end. So even if you could allocate GST exemption, it's impossible to know how much that remainder value might end up being, and that's why the IRS doesn't really allow the allocation of GST exemption here to begin with. Because of that, and because of the risk that the grantor may die during the term of the GRAT, at which point the assets are included in the gross estate, and there's allocation of GST exemption at death then, regardless. So, all that being said, that's all theoretical. It can be kind of confusing, but to really bring this home as the key lesson and takeaway here, we have to look at this from the perspective of filing gift tax returns and where things can go off the rails. And that is illustrated in this older private letter ruling I referenced, 2020-07013. And in this PLR, we had a series of rolling GRATs that were implemented over an 8-year period. So we essentially had 3 GRATs funded in each of the 8 years, creating 24 total GRATs. Each of them are assumed to be 2-year GRATs based on kind of the context of this PLR. But if you're familiar with PLRs, you know they never actually give actual numbers, dates, or years. But either way, the taxpayer here claimed that their accountants who had advised them on the filing of gift tax returns for the GRATs did not advise them that they needed to elect out of automatic allocation of GST exemption. So as a result, there was no election out, and at the end of each GRAT term, GST exemption was allocated to the GRAT based on the value of the remainder of each GRAT at the end of each term. So that might not be significant for one GRAT, but if you multiply it by 24, especially with very good growth, you can see how that might spiral out of control. Now, as you see with many written determinations, the taxpayer sought late election relief here, and it was granted based on their quote-unquote reasonable reliance on a tax professional, in this case, their accountants, who failed to properly advise the taxpayer regarding the ability to elect out of the automatic allocation of GST exemption to each GRAT. So, key takeaways here are that, for one, in my position, I routinely review gift tax returns and see them come across prepared by a variety of professionals. Could be CPA firms, could be other attorneys, could be enrolled agents, whoever is involved in this. And the number one error I see is the complete inability to even address the GST tax. Oftentimes, the parts of the gift tax return that deal with that, such as the 2632 election out box on Schedule A or the GST exemption allocation on Schedule D, are completely ignored and left blank. So, if anything, just don't do this for any return. You have to address that GST part, and if you can't, you need to get familiar with it before you continue to prepare gift tax returns. Now, if you have a GRAT being reported on a gift tax return, the good news is you have 2 bites at the apple, and a lot of people don't realize this, is at first, on the gift tax return on which you report the initial value of the GRAT, it's helpful to elect out of the automatic allocation of GST exemption if you don't want to end up in this quagmire. But even if you wanted to and you fail to do so, you still have a second bite at the apple during the GRAT term, and even for a little bit after, because the due date for the year of termination of the GRAT comes April 15th or October 15th with extensions for the year after. And that second bite at the apple is that you still have the chance for the year of GRAT termination to file a gift tax return on which you, again, can elect out of automatic allocation of GST exemption. So you have these 2 bites at the apple, and obviously in this transaction we saw in this PLR, it was done over a 10-year period when we take into account the rolling GRATs over 8 years plus 2 years for the last one to percolate and terminate. So big key here is that once you pass the due date of the return for the year of GRAT termination, it's too late. And at that point, you have to seek relief from the IRS. And oftentimes, as you see in many written determinations like we looked at today, that late relief involves throwing the tax advisor under the bus. And you do not want to be that tax advisor who gets thrown under the bus here. So if you're dealing with GRATs and you're filing a gift tax return, be intentional about electing out of the automatic allocation of GST exemption if that's what your client wants. And even to get there, you have to advise them that, look, if we don't do this, then whatever the value of the remainder is at the end of the GRAT term will be what we allocate GST exemption to. There's no certainty there. And that may be okay. They may be fine with that, especially if it's a winning GRAT, but you need to be aware of that issue and not run into that blind spot. As always, if you have questions or topic suggestions and you are a tax or estate planning practitioner, you can send those questions to griffin.bridgers@gmail.com, but note that I cannot give tax or legal advice in response to your question. So if you're emailing me about a specific situation, especially if you are an individual who could be a client, I cannot answer that. And also, if you'd like a speaker for any of your upcoming events, be it an estate planning council, bar association, conference, or whatever, please feel free to reach out below at the email address I've listed on the footnote. But I thank you again for listening to this video, and I look forward to seeing you in my future content.